Hey gang, this is Greg Barron, aka the professor in real estate development and finance and investment. Last time we talked, I told you that we would jump into a potential thumbs up project, which is a self-storage project. Now, like the last project, this was another one that we're looking at in the Phoenix area. We actually are beyond the evaluation stage and going into an execution mode, even in these economic times. So I do want to remind you, there are some deals out there that still are positive that you can jump into if you're in this kind of space. First of all, let me tell you why I love the self-storage space. During these inflationary times, one of the things that we have to deal with more than anything else, well, actually there's a couple. One of them is inflation. And the second thing is rising interest rates. What I found with self-storage developments is there are about 5 salient issues that are benefits over other asset classes right now. Let me run through those 5 with you. I don't know about you, but I've had as many as 3 self-storage units occupied at one time in my career. So I'm a perfect example of the steady income that you could have once you get stabilized. The second thing that I would say is benefits are they tend to be more resilient during economic downturns. Number 3, and this is a biggie right now, they have low operating costs. It doesn't take a lot to operate these. We have very little labor involved, and as a matter of fact, some of these we don't have any labor except for the back office accounting that we normally do on a day-to-day basis. Number 4, I found out that I can use land a lot more efficiently with self-storage units. And let me give you an example. I've looked at some that have less frontage road and are oblong in the back, but I was able to utilize all of the land for self-storage units. So number 5 is tenants tend to stay longer. I know personally in my career, I've had as many as 3 self-storage units occupied at one time. Now come to think of it, all 3 I kept as long as 10 to 12 years each before I consolidated all 3 into a warehouse. By the way, if you like this video, be sure and hit the like and subscribe button for me. Let me show you a couple of articles on self-storage, and I'll read you exactly what other experts are saying right now about the space. Let me read you this article out of Seeking Alpha, which recently said, rental movement and the need for more space could potentially help offset the lack of home sales. Operators have also been able to rely on existing customer rent increases to maintain revenue growth. While there is uncertainty over how fundamentals will perform in the last few months of the year, many operators remain cautiously optimistic as the sector has historically stayed resilient during economic shifts. In a recent article by News and Insights, it says you can profit off Americans' tendencies to be hoarders. As of 2022, there were 50,000 self-storage locations across the U.S. According to Storganize, a self-storage facility can earn an average of $365,000 to $800,000 per year. So now I want to jump into Performa Plus, the real estate financial modeling software that we use, and show you just how we put this deal together and why I think it could be a good thumbs up development for us in the future. So as we jump into this, a couple of data points that I want to point out. We purchased this property for about $12 a foot. It was right around 217,000 square feet. That comes up to right around $2.6 million. We designed it to right around 425 units, and I'm going to go briefly into the building income section, which will show you how we parceled each individual unit out. The loan covenants that we had back on our term sheets from the bankers were right around 8% for a construction and for a long-term mortgage. So that's what I'm going to use for this presentation. As far as a debt service coverage ratio that we discussed last week, we have to maintain at least a 1.3 or greater, or 30% greater than our net operating income when we reach stabilization. So I want to point out a few things on the Performa as you follow along with me. We've got 8% plugged in for our construction loan. We've got 8% plugged in for our senior debt for our mortgage. We have got a 7-year loan term amortized over 20 years. But let's go to something a little more important on this particular project, which is the building income and the stabilization. I want to show you here first off, with this software, we're able to add the individual storage spaces according to the size and according to the rate that we're charging per square foot. And I won't go into all the edit features, but it's actually quite simple. So we've got several different sizes of units, 10 by 10s, 10 by 15s, 10 by 20s, 10 by 40, and 20 by 20 by 8. And we've got some RV storage spaces as well. If I wanted to change any of the square footage, or if I wanted to change the square foot rate that we're charging, I just simply go in here, change the rate to whatever it is, and then I resave it right here, and it recalcs everything, including back into the Performa. Really pretty easy. We'll go over that in a subsequent video because this is pretty important when you've got multi-unit facilities. But the main thing I wanted to talk to you today was actually about the stabilization. Now, if you go into the setup under this particular one, stabilization is really important because it's the time and the velocity that it takes for units to lease up. We're hoping that there's going to be a significant amount that are pre-leased, and then over time, the velocity of leasing is like an S-curve. It's going to be sharper in the beginning, and then it's going to trail off, ultimately leading to what we feel is a stabilization period of time. Now, under a normal circumstance, we would get very particular and we would create a number of stabilization months in here, but for ease of presentation, today, we're just going to use a % of occupancy. So what we have determined with this facility is in year one, we've got pre-lease and we've got occupancy of 50%. Year two, we've got a vacancy of 30%, year three of 20%, and actually in year four, we reach full stabilization. That's fairly conservative, but when I'm going to the bank, I would rather be on this side of conservative than anything else. As you can see, we've extended it all the way out to year 7, which we would consider our exit date. So if I go back into my project center, it just recalculated everything that I put in there. And I want to point out a couple of things because in our scenario, there's 2 things that I want to look at. Actually, 3 things I want to show you today. One of them is our debt service coverage. This automatically figures it for us. And you remember that from the last video, our term sheets now are requiring us at stabilization to have a 1.3 or greater stabilization. So as I look at our evaluation here, we don't reach that in year 2 because we still are ramping up in velocity. But in year 3, we reach a 1.5 or greater. So actually, as it's stabilized, this one actually performs quite well, and it just continues to climb. This means that it's 55% greater than our net operating income. And in this last year, we're actually at 5% vacancy. We're at 1.7. It's a heck of a performer. The other thing that I want to point out, since this is a sponsor and investor project, we do have other investors that are joining us, and it does have a waterfall investment feature to it. I won't go into it now. This will be a subsequent video, but we're able to insert all of our percentages for our preferred rates for our investors and sponsors in however many waterfall scenarios we want to have. And the beauty of this particular software is that it automatically recalcs the sponsor returns and investor returns on the fly. And it also figures the equity multiples of both the sponsor and the investor. That'll be something that we go into in a later video in depth. So let's end on this note of internal rate of return, which everybody is interested in. We have a functional capability at this point of actually having as many scenarios as we want. For this one, we have determined that our cap rate is 5% in this space. In this particular financial performance summary that we have developed, this project right here will have an internal rate of return at 32.86 at a 5% cap rate. Now, to close out this video, what I want to show you is how all this information is ported over to determine internal rate of return for the deal. Here, we have 3 different scenarios for cap rates: 5%, 5.5, and 6%. Each of these will develop different pro forma analysis, different sensitivity analysis with each cap rate that we have. I like to see it this way because I want to be able to view it, and frankly, I want to be able to change it if the market shifts. So right now with this scenario, based upon column number 1 up here that I've designated, it's telling me that we'll basically have a 32.86 internal rate of return, and that is before tax. That equates into this deal, at least with our financial model, distributing over the life of this particular self-storage facility an equity multiple somewhere in the range of a 4x for our investors, or a $10 million return. The last thing that I want to look at, and which is a qualifier for us, is we need a cash-on-cash return of north of 7 to 8%. We prefer 9, but in this economy, a minimum of 7% and greater than 20 to 25% internal rate of return. So if you look down here, we actually see cash-on-cash returns from 7.92 to 11.69 over the first 3 years that we have modeled it. So as you can see, this particular self-storage development project that we looked at meets the criteria of debt service coverage ratio of greater than 1.3 at stabilization. It meets our cash-on-cash requirement of greater than 7 to 8%, and it meets our internal rate of return targets of greater than 20 to 25%. This particular deal is a thumbs up. Thanks again for joining me today, and always remember E to the power of 3. Educate, evaluate thoroughly, and ultimately execute for your future financial success.